think silver is highly likely to go to $300 to $500 in the next handful of months. Right now, we view the monetary metals as the place to be. No, they've not reached any kind of targets. Gold, even just reaching a norm, would be 8,000 plus, eightfold.
How closely should we be watching those inventory levels at the COMEX?
Don't watch them at all. Those come and go. These sideline stories come and go, and they're all part of the ongoing wave that's underway. But remember, this wave has been underway for decades. Suddenly, in the last couple of quarters, you went vertical, quadrupled, bam. The difference this time is we've come up out of a massive 50-year range as well in price. Momentum already did it well before price did, by the way. And I think we're in that phase where suddenly a market that has been underpriced for too long catches up to its reality and probably even overshoots. Eric Sprott, the silver guy, made a comment in a speech I remember. He said, look at the money supply. Go back to 1980, look where the money supply was and look where it is now. How much gain has there been? And do your math on where silver ought to be. Gold knows this. It is money. It's unfettered money. Government can't manipulate it. Well, silver is the one we're watching right now most, because silver is vastly underpriced to gold. It's vastly underpriced to every asset on the planet in terms of history. You go back and measure, where's the S&P and silver ratio? Divide silver into the S&P, divide silver into gold, divide silver into whatever you want, especially back late last year when it was still in that 50-year range. $4 to 50, $4 to 50. You have 50 years. No other commodity on the planet, no other base metal, for example, copper and lead, had blown out through a multi-decade similar range and done it back in 2005 for copper, 2007 for lead, quadrupled in price above that range high on their own without a wave effect from other markets. And yet silver's confined for 50 years. What if silver catches up to gold? What if silver, on a ratio basis, or not a ratio, but divide silver into gold? You go back to 1980 when silver was 50 at that peak, the Bunker Hunt peak. It was 6.5% the price of gold. Okay. Then in 2011, silver again went back to $50, again in that 50-year range, and it was 3.1% the price of gold. Divide silver into gold. Right now, it's 1.5 or 1.6%. What if the ratio, the spread difference between silver and gold, goes back to those old highs? 3%, 6%. Whoa! We're talking $300 to $500 silver, which is what we're targeting for silver, by the way, probably within the next handful of months.
What sounds like a bold silver call is really a warning about how distorted relative pricing may have become. As Michael Oliver points out here, silver sitting near 1.5% of gold's value is far below the 3.1% level seen in 2011 and the 6.5% level reached in 1980. That does not automatically guarantee a surge, but it does show why some investors believe silver is still lagging badly behind monetary inflation. The deeper issue is whether capital finally rotates into ignored hard assets after years of crowding into equities. Next, Michael Oliver discusses why long suppressed markets often move hardest once that restraint breaks.
I think that's the place to be within monetary metals, because it is the one that has been restrained for so long, for whatever argument you want to use is why it was restrained, outside manipulation or whatever. But when a market makes an error and underprices itself for too long or overprices itself for too long, like a bubble, when they break, they often overdo it the other way. They correct for the error, but they overdo it. So, for instance, the dot-com pop, instead of dropping 50%, dropped 82%, nearly wiped itself out. It took it till 2016 for the NASDAQ to even get back to its 2000 high. Okay, now, you get the point. Silver's in the same position. So right now we view the monetary metals as the place to be. No, they've not reached any kind of targets. Gold, even just reaching a norm, would be 8,000 plus, eightfold. And silver is nowhere near any normality. And technically, when you measure that spread relation between silver and gold and plot it as a chart, silver broke out back in November above a 10-year range of readings. So it said, hey, I'm out of this hole. I'm coming up. Okay. Where was silver then? $56, the November close. That was our last long-term buy signal for silver. That was it. No more. We're not going to offer any more major buy signals. If you're coming in now, you're late, but you're still going to make a lot of money.
The part many investors miss is that markets rarely stop at fair value once they finally reverse. As Michael Oliver points out here, the comparison is not just silver versus gold, but how deeply mispriced assets can overshoot after years of suppression. The Nasdaq needed 16 years to reclaim its 2000 peak after the dot-com collapse, showing how long distorted markets can take to normalize. That same logic cuts both ways when an undervalued asset begins repricing upward. Next, Michael Oliver talks about why silver's breakout may matter more than the headlines investors are watching right now.
But $56, look what happened between that spread breakout in November, close in November, December and January, we're at 120 in 2 months. Yeah, you're back to 80 right now. But still, you're 80 versus 56. Whoa, what gain that's huge. And I think silver is highly likely to go to $300 to $500 in the next handful of months and do effectively what copper did in 2005 and 6, what lead did in 2007, and also change its relationship to gold to a more rational pricing.
Last question for you, just because given your background, I'm just curious here. How closely should we be watching those inventory levels at the COMEX?
Don't watch them at all. Those come and go. These sideline stories come and go, and they're all part of the ongoing wave that's underway. But remember, this wave has been underway for a decade. Silver and gold rising. Yes, it's been an arm wrestling rise where you say, well, was it rising? Sure it was. Yeah, look at it. Of course, silver was 10 years ago, 5 years ago, 1 year ago. It's been rising, okay? But it's not been parabolic. We've entered the parabolic phase, meaning you get more done in the final couple quarters of this bull surge than you did in the entire portion up to this point in time in terms of gain, which is similar to what happened actually in 80 and 2011, where you've been underway for several years in silver on the upside.
The sharpest moves often happen after most investors already think they missed the trade. As Michael Oliver points out here, a move from 56 to 80 is not just a price change, but a sign momentum, maybe accelerating faster than sentiment can adjust. His dismissal of COMEX inventory stories also challenges the constant media habit of focusing on short-term noise instead of long-term structure. For patient investors, the real question is whether silver is entering the late stage of a decade-long repricing cycle. Next, Michael Oliver unravels why parabolic phases can change investor psychology very quickly.
And suddenly, in the last couple of quarters, you went vertical. You quadrupled. Bam! The difference this time is we've come up out of a massive 50-year range as well in price. Momentum already did it well before price did, by the way. And I think we're in that phase where suddenly a market that has been underpriced for too long catches up to its reality and probably even overshoots the reasonable. And another way to look at it is this, Eric Sprott, the silver guy, made a comment in a speech I remember. He said, look at money supply. Go back to 1980, look where the money supply was and look where it is now. How much gain has there been? And do your math on where silver ought to be. Do the same thing at the 2011 peak in silver, when silver was $50 and now it's 2026. What's happened in the last 15, 16 years in monetary growth? Therefore, if silver reflected that, where would it be? And he came up with numbers in, $300 to $500 range. And so even in a broad measure using that simple tool, sort of a non-technical tool, it makes sense. But we do it technically and using momentum, and we argue, no, silver's headed into one of those tantrum phases that you don't see very often, but it has occurred in other markets at other times, upside and downside. In this case, silver is finally waking up to a new reality, and it will probably achieve that reality so fast that most investors simply won't catch it.
Sometimes momentum signals the shift before price convinces the crowd that anything has changed. As Michael Oliver points out here, the more important signal may be that silver already escaped a 50-year trading range before most investors started paying attention. Linking silver to money supply growth also forces a bigger question about whether fiat expansion has quietly distorted every traditional valuation model. Investors often wait for confirmation, but by then the largest percentage move is usually gone. Next, Michael Oliver discusses why delayed recognition can become the biggest risk in a rapidly repricing market.
Gold knows this. It is money. It's unfettered money. Government can't manipulate it. They can ban it, like Roosevelt, during that era. But basically, since gold was legalized again in 75, gold is in massive waves, continue to up and discount the ongoing destruction in the real value of the money. And that, I think, is the central driver that we're seeing right now.
So when you think about precious metals and how they tie in to this environment, I mean, there's been some, it's funny because I'm sure you have conversations with some of the big financial thought leaders out there, and there's kind of two schools of thought. There's obviously the gold bugs who think that it's real money, and it's going to have its time really to shine here over the next era. And then there's some people who say, well, gold it's this kind of worthless shiny metal. It doesn't really have a whole lot of production value. It's basically just backed by the belief and faith of people who think that it's going to be worth more. It's effectively just a greater fool asset. What's your sort of thought process when you're chatting with people who sort of are more on that maybe academic side, that kind of sort of scoff at gold and say that, well, there's no reason for it to keep going up other than people buying it?
The real divide is not about gold itself, but about what people still trust in the financial system. As Michael Oliver points out here, gold tends to reflect the long-term erosion of purchasing power more than a simple commodity cycle. Since 1975, every major monetary expansion has eventually pushed investors back toward hard assets, when confidence in paper promises weakens. Critics call gold belief driven, yet modern currencies also depend entirely on confidence in policymakers. Next, Michael Oliver talks about why that confidence may be far more fragile than many investors want to admit.
If I landed from another planet and said, what's your money? I could kind of appreciate it, because what else is there? Okay. For 3,000 years, gold and silver, emphasize that, have been money here, there, everywhere, in various civilizations, including U.S. We've had monetized gold and silver. India's moving in that direction. China's moving in that direction now. And if we hit the crisis I think we're going to hit, meaning the bubble breaks again, as it always does once it gets distorted too big, then you're going to have pain. Like, in 2007 to 9, even if you weren't in the stock market, you had pain. You got laid off. All kinds of problems for the average guy. Well, this time the bubble is huge, so when it breaks, it's going to hurt a lot of people. That causes doubt. And then you inject emotion into the thought process on the part of academicians and average guy on the street about, this isn't working. The hell's working? Well, the only thing that seems to have worked over time and kept things stable is when you have monetary metals in play. And so, you can doubt it and say, well, what's the purpose of that? It's just a limited access metal. How come it's got that tradition? It does. That's all I can say.
The deeper point here is not really about metals, but about trust breaking under financial pressure. As Michael Oliver points out here, every major asset bubble eventually becomes a social event once ordinary people feel the damage outside the stock market. The 2007 to 2009 crisis showed that even people with no direct equity exposure still felt layoffs, inflation pressure, and shrinking stability at home. When that kind of confidence cracks again, investors often reconsider what actually holds value when policy credibility starts fading. Next, Michael Oliver discusses why modern alternatives still struggle to replace that historical role.
And some of the alternatives that people try to come up with don't have any limitation to them, like money supply when it's controlled by government without any backing. And now in the last 10 or so years, we've come up with the cryptos, as if that's an alternative. Well, define that to me. Tell me where can I touch one of those? Where is it? What use does it have? At least silver and gold have a use. You can put them around your neck. Silver is an essential industrial metal in high tech, in solar, etc. So at least you can say, well, I can understand them. At least they're limited. They're not controlled by a government in terms of quantity. Can't push a button and suddenly there's a lot more. And they've been around forever. And yeah, maybe when we evolve into space, we won't need them anymore. But right now, that's what we've got. There.
Now, when you think of how we're currently in a bubble, do you think that a lot of that is just the fact that the words quantitative easing were said, and capital allocators, or we say fund managers, basically people who have money to invest, they've kind of just come to the conclusion that governments will not allow for pain to happen. And no matter how bad it gets, the Federal Reserve's always going to be there. Maybe they create a facility, they do quantitative easing. In Canada, by the way, they didn't call it quantitative easing. They called it LSAP, for large-scale asset purchases.
What often gets ignored is how much modern investing now depends on belief in endless intervention. As Michael Oliver points out here, many portfolios are built on the assumption central banks will always cushion losses before markets fully reset. That mindset changed dramatically after years of quantitative easing made investors treat liquidity like a permanent safety net. The danger is that confidence itself can become the most crowded trade when every institution expects rescue at the same time. Next, Michael Oliver unravels why that policy dependence may be creating a much larger vulnerability beneath the surface.
And then at the press conference at the time, when they had Tip Macklem at the mic, they kept asking him, "How's this different than quantitative easing?" And after like the fifth time of being asked it, he just conceded, it's the same thing. Okay, it's the same. We're just and like, for people who have distrust of central banks, I don't think that there could have been a worse thing to have done. But most people don't even know that. But do you think that that's a big part of why we have bubbles right now? Is that just in general, people who have money to invest have come to the conclusion that the Federal Reserve and the central banks won't allow pain to happen?
Yeah, well, the pain happens anyway, because there's a point at which reality takes over. They distort reality, and there's a point at which finally you get too far for too long in distortion of a given market, and especially the stock markets. And when they break, they take over. To hell with the central banks. You go back and look at all these tops we talked about, and look what the Fed did at those points in time when they finally realized, oh shit. And they started printing and doing QEs and all the things they come up with, and who knows, maybe there's something new they've got. I don't know. It doesn't work. The bubble breaks anyway.
The language changes, but the policy often stays exactly the same underneath. As Michael Oliver points out here, investors tend to react to new labels, while central banks quietly repeat the same liquidity playbook. That matters because repeated intervention can delay price discovery without removing the imbalance that created the problem in the first place. History keeps showing that distorted markets eventually overpower policy narratives once valuations stretch too far beyond fundamentals. Next, Michael Oliver talks about what previous rate cuts reveal when markets finally stop believing central banks can control every outcome.
I mean, look at the declines. They did QE in November of 2008, but they started cutting rates at the top month in October of 2007. S&P had been topping in a range that MSA had predicted a year before you would peak between 1550 and 1600 the next year. At the end of 2016, when we said that, S&P was 1400. In summer of 2007, it got up to 1550 and dropped sharply. Came back up in September of 2007. Again, the mortgage crisis building and building, as the deep short guys knew it would. Nobody believed them. And you punched up to a new high after September of 2007. Why? The Fed came in and cut rates by 0.5 point and surprised people. It was a surprise cut. And the market shot up for a couple of weeks into October 2007 to an all-time new high, 1576 in our zone. That was it. And you started down for the next couple of years from 1570s to 667. And they cut the rates all the way down, and they even did QEs, and it didn't stop it. What did it fuel? The ongoing bull trend in gold, which had already been underway. And anytime the stock market does top and break, 2000 to 2002, for example, they cut rates all the way down. Did it stop it? No. Look at the Fed funds rate chart now even. We've got what? We went up to 5% recently. And you say, well, they raised rates, in the last 10, 15 years from a zero level, by the way. 10 of those 15 years, we had like free money. Okay.
Sometimes the first rate cut is not rescue, but confirmation that something is already broken. As Michael Oliver points out here, the Federal Reserve began cutting in October 2007. Yet the S&P still collapsed from 1,576 to 667 despite aggressive intervention. That pattern matters because investors often interpret easing as bullish even when it historically arrives near major turning points. Gold benefited while equities kept falling, showing where capital moved when confidence in policy weakened. Next, Michael Oliver discusses why even today's higher rates may still be far looser than investors understand.
But even the upticks in the short-term interest rates are trivial compared to the history of Fed funds rates. They're still in the lower third quadrant of where rates have been for 75 years, determined by the Fed. So they've kept rates low, and we've had a bubble, but when it breaks, I guarantee you it will happen again. It doesn't work. Okay, it doesn't work in terms of saving that bubble asset. And always, when you go back and look at all these big bear markets, these monetary bubble breaks, when they print, the money goes somewhere else. It always goes into gold.
What feels restrictive today still looks historically loose when you widen the lens. As Michael Oliver points out here, even after recent hikes, short-term rates remain in the lower third of the Federal Reserve's 75-year range. That matters because many investors are treating current policy as tight when long-term data suggests liquidity conditions remain unusually supportive. If that support fails during the next downturn, money may rotate faster than most portfolios are positioned for.